One thing before we go, I just want to bring up something I forgot from school, but it's called beta. And beta is a measure of volatility slash risk. And it's interesting here because they found, and they're not saying what the time period is, but REITs had a beta of a 0.94, where the S&P had a beta of 1.17, which means dividend growth had lower risk in REITs than the S&P 500 over the long term. That's interesting. And so I think one thing that I'd really like people to think about is think about not just the return, but think about the risk of that return, particularly something called the beta. I think would be just another way to think through things.
So is that industry, you think? Some industries have a higher risk than others? Because
Of
real estate in
course.
general, we tend to assume is going to go up in value, right? And so I think there's a lot of faith, back to faith and belief that the idea that, real estate values go up. So
I think
even,
over the long
yeah,
term,
yeah,
absolutely.
even
Yeah,
no
not
matter what's
everywhere.
going on with the economy, you can kind of rely on the value of real estate to be increasing over time is kind of
Well, and I
and
like the idea because people need a place to live, right? There's no
yeah.
question about that.
But a lot of these big companies, these big blue chip stocks from the '50s, don't exist anymore, or General Electric is not what it was, in the 1950s and '60s.
Yeah,
So
right, right.
you end up with we don't know